Welcome back to the channel. Like always, my name is Jose Najarro and I am a self-taught investor looking for investments to grow my long-term portfolio through fundamental analysis. I am excited about today's episode. Today we are going to take a look at two stocks that should definitely be on your watch list right now. The first one is going to be Zoom. They just reported earnings and they're seeing strong triple-digit growth sales, and the guidance they're giving is insane. The second company is one that is recently IPO'd. I think they IPO'd in August, and ARK is buying them like crazy right now. They are pretty much like the Zillow of China, so we are going to take a look at them there. And like always, for each stock, we're going to do technical analysis. We're also going to do fundamental analysis, and at the end of each stock, I'm going to give my overall thoughts on the company. But before we start, make sure to smash that like button. It helps so much with the YouTube algorithm. And on the description and the pinned comment, you should also see a link to my Discord channel. It's free to anybody that wants to join. We have over 1,000 members there. And also you should see a link to Webull. If you sign up using that link and deposit $100, we both get a free stock. I think right now they're doing a special. We might get 2 or 3 stocks. So make sure to do that as well. All right, so the first company we are going to take a look at right now is Zoom. Like I mentioned, they just reported earnings. Right now it's sitting at about $454 after hours. They're down 5% after reporting earnings. Right now, market cap for Zoom is about $125 billion after that drop. And this is ticker CM for those that are not familiar. Year to date is about 596%. That is insane, right? Crazy amount of growth. Let's take a look at some technicals on Zoom right now. So right here in the charts, I'm looking for two things. First, is it overextended from its moving averages? And second, is there plenty of volume where it's at right now? So we can see right now with that stock drop of about $450, we can see it has dropped down a little bit more to its moving averages, so it's not as overextended. The second thing I'm trying to take a look at, is there plenty of volume where it's at right now? I can see there's definitely a lot of volume within this whole range right here between $400 and $500. A lot of people have bought Zoom there. So all that tells me is that there's going to be some form of support around those levels, especially here in that 400 level, 393. We've seen it being tested a few times and it's bounced off. So that tells me that, hey, these are price levels we should definitely take a look at if we want to enter Zoom. So now let's take a look at their most recent earnings. So their earnings were amazing. And you might be like, Jose, how are their earnings so amazing, but the stock price dropped? And this is the case of what happens when some of these stock prices are priced to perfection. And what that means is investors are expecting way too much from these companies, that if they don't deliver beyond what they're supposed to deliver, then the stock price drops. And I do believe that's what's happening here. Even though amazing results, we're seeing, look, 367% year-to-year growth on revenue. They're now making about $777 million on this quarter. They are seeing huge growth in customers with 10 employees or more. That's 485% growth. And then they're also showing the number of customers contributing to more than $100,000 in trailing 12 months revenue increased 136% to 1,289. Right now, they're also super free cash flow positive. They have about $388 million of free cash flow positive. And we're going to take a look at that balance sheet in a bit. They have so much cash right now compared to any debt that they own. So in this earnings, they also mentioned a few things that they're coming out with, or some items that have just been recently released for Zoom. And Zoom, if I may be honest, I'm not a bull in the case right now, just based on that market cap, right? We saw a market cap of about $125 billion. Maybe I might just be a little bit too close-minded that I don't see how much more this company can grow from here, but they're constantly delivering new products that maybe other investors might see what I don't see. In the quarter, Zoom said that its premium Zoom phone has expanded to over 40 countries and territories. They're also mentioning that Zoom would come to the smart home devices made by Amazon, by Facebook, and by Google. And the company also announced on Zoom, which is going to be a tool for putting on live virtual events that people can attend by paying fees. So this is changing the world right now, right? Right now, with everybody being home due to the pandemic, they kind of made this live virtual events. So we're gonna see how that is gonna grow. I do believe that's a smart move to make, especially for maybe startup companies. Let's say I, for example, wanted to do some form of virtual event where I talk about the stock market or stuff like that. Using this on Zoom tool would be a pretty cool tool where I don't have to go and reserve a whole freaking stadium or some sort of that. So you can see that they're innovating new products, which is pretty cool. The next thing we want to see is they're growing international. We're seeing year-to-year revenue growth for the rest of the world is growing 629%, and in the Americas is growing 302% compared to the same time last year. So this is pretty insane. Right now we can see America is still a major portion of this company's total revenue, making up almost 70% of the total revenue. The rest of the world makes up the other 30%, but that's a lot better compared to same time last year. Same time last year, 80% of the revenue came from America. So we can see that we're still seeing strong growth in the Americas, but they are expanding dramatically in the rest of the world, so they're grabbing a lot more market shares. Another thing I want to show is they have so much money on their future contracts right now. So they have deferred revenue and they have unbilled. So unbilled are services that they still haven't gotten paid for, and deferred revenue are services that they've gotten paid for already, but they have yet to provide. Maybe it's a yearly subscription, so they've only done about 2 months of that service. The customer still has about 8 months, for example, 10 months, for example. So that's deferred revenue. And you can see the increase of unbilled revenue and deferred revenue is insane compared to the same time last year. Last year, that was about 517 million. Right now, it's about 1.6 billion dollars. That again is insane. Now, they also did give a guidance for Q4 of this year, and the guidance continue. All right, I'm saying, even though I'm not a bull or a bear of this company, I can still appreciate a strong company. And the type of growth Zoom is seeing right now, I'm talking more in the business sense. Again, I'm not talking based on valuation, but as a business point of view, Zoom is an amazing company with this type of growth, right? For Q4, they're expecting revenue to be 806 million to 811 million, and for the overall consensus is about 719 million. So they're being a lot better than what analysts expect. They also expect non-GAAP earnings per share to be 77 cents to 79 cents. And for the full year of this year, they expect about 2.57 to 2.58 billion dollars of revenue, and about $2.85 to $2.87 on non-GAAP earnings per share. So this type of revenue for the full year will give the company 314% year-over-year growth. So next, I want to take a look at the type of growth Zoom is expected to see in the upcoming year. Analysts expect Zoom to grow about 26.2% on average annually for the next 3 to 5 years. This is a hyper growth stock. What else are we seeing? Zoom is profitable in GAAP earnings per share right now, and they are also positive in cash flow from operations. So Zoom, like I'm saying, I can truly appreciate this business in the type of revenue growth and the type of money it is providing, that cash flow from operation that it has, and the profitability. It's definitely a strong company. If we take a look at their balance sheet, it's also pretty amazing. They have about $3 billion in total assets and about $700 million in cash and cash equivalents. They have about $1.5 billion of total liabilities, but more than half of that total liabilities actually comes from deferred revenue, which to me, it's a fake liability in my opinion. So next, let's take a look. I'm just gonna end with my overall thoughts on Zoom. But before we do, guys, make sure to check out my second channel, Jose Najarro Entrepreneur, where I talk about other things outside of the stock market to become successful or to get money or to be smart with your money. So make sure to check out that channel. I truly appreciate it. And also check out the merch, Self-Taught Investor. I'm pretty sure most of you guys are like me, a self-taught investor. So my overall thoughts on Zoom. First, my biggest risk, and I don't mean it, a risk doesn't mean that it's gonna happen. It's just, right, it's just something that has the potential to happen. It's the risk. Right now, with the current valuation, I do think it is, in my opinion, a little bit too high for closure. And this is one company that I've been completely wrong with. I've thought it's been overvalued since it was in like the $300, $250. And we can see I missed that boat. But that's okay because I have a plan. Maybe your risk tolerance is different than mine, and it's okay for you to purchase based on your risk tolerance. But we see strong year-over-year revenue growth. This is impressive. They have an amazing balance sheet where they have plenty of cash. They had no debt, and half of their total liabilities is actually deferred revenue. The company is also trying to innovate with new products. I'm not sure how well those new products are gonna do, but but that innovation is coming in. We're also seeing positive free cash flow from operations and positive earnings at the moment. So Zoom definitely as a business is very, very good. But like I mentioned, for me, it's not willing to meet my risk on this on this valuation. And again, maybe it's just because I'm not too excited about the market. But again, some other investor might be a little bit more excited and might oversee some of those risks. The second company we're going to take a look at is KE Holdings, and this is ticker BEKE. Right now, it has a market cap of about $77 billion. It is sitting at $65.33. And like I mentioned, ARK Investment has been buying it. I actually saw it today, and it got me kind of intrigued, and I want to do some more research on them, on what they do. So this is a Chinese-based company right now, and right now is sitting about 14% from its all-time highs. They recently IPO'd. They IPO'd in mid-August, I believe, and the IPO price was about $16, but it opened up at around $35, and right now, like I mentioned, is sitting at around $65. So I've seen some huge growth. So let's take a look at some technicals. Like I mentioned, right now it is down about 14% from its all-time high, so it has pulled back a nice amount. Next, is it overextended? We can see it is now within its moving averages. The second thing is that there's definitely plenty of volume between $60 and $65. We're seeing a lot of investors coming in here. So that's telling me that this is going to provide some form of support, especially here at this $60 level. We've seen a few bounces here, we've seen a bounce here, and now is uptrending back again, right? For me, like I mentioned, I'm a long-term investor, so technical analysis is not something I truly look at, but it's not something high on my list, but it's still something I look at and want to see how things are going. What is this company, KE Holdings? They're also known as Beke, maybe I might be pronouncing it wrong, but it's Beke, and they are the owners of two leading businesses. The first one is Lingia, and the second one is Beke. So Lingia is a leading real estate broker in China that helps owners rent or sell their properties and help customers find a house to buy. So again, pretty much a real estate broker. If you're trying to rent a property, trying to sell a property, or trying to find something, trying to buy one of those, or trying to rent, you use this platform. The second one is Beke, which is a real estate platform that facilitates housing transactions and services. So we can see this is pretty much the Zillow or kind of a Redfin of China. So a lot of people are very excited about this company. We can see ARK Investment is very excited. If we take a look at their most recent earnings for quarter 3, they have non-GAAP earnings per share of 20 cents and GAAP earnings per share of -5 cents. So they're not profitable in GAAP earnings, but they are profitable in non-GAAP earnings. Their most recent quarter had a revenue of about $3 billion, which saw 70% year-over-year growth, and it beat expectations by about $370 million. That's over a 10% beat. Now let's take a look at future growth for BEKE, and this is also KE Holdings. Right now, future growth, they're expected to grow their revenue 24.5% annually for the next 3 to 5 years. Again, another hyper growth stock. We can see they're not profitable right now, but are expected to be profitable by early 2021. But they are positive on cash flow from operations. So they're making money from their everyday activities. If we take a look at their balance sheet is looking pretty good. They have about $51 $8.2 billion in Chinese yuans, and they have about $7.8 billion in debt. So they have way more cash than they do have debt. They have positive cash flow from operations. So this to me is a very, very strong balance sheet. Other thing I want to show is their top shareholders. Right now, their founder owns 40% of the business. That is insane, especially since this company already has a market cap of about $80 billion. So for them to own such a big portion, that tells me some bullish scenario. The second thing is Tencent Holding actually owns 11% of the company right now. As many of you guys might know, I am a big Tencent fan, big bullish on them and their gaming aspect, and it's pretty cool to see them having other assets outside of gaming. So now let me give my overall thoughts. But before I do that, guys, also make sure to check out the link below for 7 Investing, where every month they recommend 7 stocks for only $17 a month. And if you use my link or my promo code JOSE, you get $10 off the first month. They're about to give their new recommendations tomorrow, December 1st, at the first of the month. And the great thing is you also get to see their past recommendations. May I say, yes, this is an affiliate program, but I use their services and would recommend it to anyone. So now back to Beke. So what are my thoughts? First, the overall market. I do believe that market will continue to grow, right? The real estate market, especially in such countries that are developing so fast, is going to continue to grow, right? So it's definitely a market that I can see potential growth. We're seeing ARK Investment Holdings. We're seeing a strong still ownership by the founder, owning 40% and being backed up by Tencent as well. We're seeing strong revenue growth, a very strong balance sheet, and in form of technical analysis, they are sitting at a nice price level. The only thing, right, I want to say is they saw about $3 billion in revenue this quarter. Let's assume for the year they have about $12 billion. That gives this almost a price to sales ratio of somewhere between 8 to 10, based on how the previous quarters have been going, which is not horrendous. It's probably one of the cheaper price to sales ratio that is out there. But remember, this is an international company, so that comes with a lot of risk. That comes with that tension right now with the United States and China. So usually investors see that, and that's why they give them a lower price to sales ratio. But I still believe that it's one to definitely keep an eye out. I'm not 100%. This one is very interesting, but not one I'm sure I would buy either. So right now, both Zoom or Beke or KE Holdings are ones I would add to my portfolio, but are definitely ones I would add to my watch list and continue looking at them and see how they're overall moving and learn more about their business before I even try to jump in. So I hope you guys enjoyed today's episode. Like always, make sure to subscribe, make sure to hit the thumbs up. It helps so much with the YouTube algorithm, and I truly appreciate it.